All right. Hi, everyone. Thanks for the messages. Okay. First off, hope everyone is doing well wherever you are amidst the crisis that's going on. As well, a few key pointers regarding the webinar. If you have any questions, feel free to write them down the chat. I have it open, as well as some of our team members. If it's related to a particular slide or content that I'm referring to, I'll make sure to go back to that slide, to that part of the presentation to answer your question. If it's related to something else, our team will also be looking at the chat and answering questions promptly. Finally, we will be recording this presentation. So if you're not able to stay for all of it, or you would like to share it with some friends or team members, make sure to share it. We'll be recording and posting this online in our YouTube page tomorrow, as well as uploading our slides. So let's get started. I will start talking about a brief overview of traditional portfolio theory and some of the key differences with how it compares to crypto finance. Then I'll dive into the approach that we've been taking at Into the Block to tackle the issue of this whole process of analysis for portfolio analytics as it affects crypto assets specifically with their different nature. And finally, some of the key insights that we've derived from our infrastructure of analytics and what's to come with our product. Okay, hope you guys enjoy. Well, I'll start. I suspect some of you might already be familiar with some of the portfolio analytics tools out there, since they've been here for almost decades and decades, seriously. So I'll try to go briefly over these topics. Modern portfolio theory was introduced by Harry Markowitz, who won a Nobel Prize for this work that he introduced in 1952. It's essentially combining, it introduced the concept of combining risk and return. I imagine most of us are familiar with those two topics, which are essentially household topics in terms of portfolio analytics. Essentially, expected return given a level of risk. It was the whole idea of this, where risk is calculated as the standard deviation or variance of the returns. And another key concept that he established was the diversification based on asset correlations. So as many of us are familiar, and it's been raised in the context of crypto space, asset correlations can be positive or negative, especially if they're too positively correlated. It is usually negative, as it's not well diversified. And he introduced the concept of the best possible capital allocation line in this chart. Essentially, when you're at this capital allocation line, you're maximizing your expected return given your risk or standard deviation in this case. And you can compare your assets within your portfolio along the efficient frontier within more modern portfolio theory. Some of the tools I want to get into, some of the tools that are used for portfolio allocation in traditional finance. So usually you've probably seen either in a robo-advisor or very traditional financial advisors, how they ask you about your risk profile, maybe your age, your risk tolerance, essentially. Based on that, you can either be recommended like a percentage between portfolio and bonds allocation. One that's very common in the US, at least, it's a 60-40 portfolio, where 60% is allocated to stocks and 40% to bonds. However, it doesn't really consider traditionally alternative assets such as gold or cryptocurrencies, of course. And some of the limitations, well, there's been a lot of criticism recently with this approach to portfolio allocation, as it assumes that there's a negative correlation between stocks and bonds, thus making it more diversified. But this has actually been proven incorrect in the past few years, especially with the past March panic and well, with a subsequent increase in asset prices all around. Another technique for portfolio allocation is Kelly criterion, which is more probabilistic. more advanced. I will not get into the details, but it's something we've used at Into the Block in our predictions efforts. So what about tools? What can you use to analyze your portfolio and positions, at least in traditional finance? Of course, there's profit and loss. We're all familiar to that as a correlation, as I've been talking about. Sharpe ratio, so it essentially compares your return minus the risk-free return, which is usually US treasuries, at least if you're in the US and in those capital markets, over the volatility. So it's a similar concept to the one introduced by Harry Markowitz. It divides over, assumes that risk is equal to standard deviation. If you think about it though, your risk, if you're long, is you only care about volatility to the downside. So there's an adjusted ratio, which is a Sortino ratio, which the denominator is downside risk. So it takes into consideration the volatility to the downside. As an investor, you probably don't care if your asset is volatile, but makes you more earnings. So that's the logic behind that. And there's tracking error, which is a risk-adjusted standard deviation versus a benchmark. So it's usually compared in regards to another ETF or benchmark in the same industry. Could be towards NASDAQ or maybe IIU if you're buying gold. And then finally, there's the information ratio, which combines essentially the two concepts of tracking error and Sortino ratio to provide risk-adjusted versus a benchmark. Now I'll get more into the details of how we've looked into it at Into the Block, comparing traditional finance versus crypto finance. For starters, you all know crypto is 24/7, whereas traditional finance in the US is only from 9 to 4 p.m. I know in other financial markets, it's different trading hours, but none of them are 24/7 as the digitally native crypto asset finance. Types of assets, well, there's equities, bonds, commodities, derivatives, cash. And in crypto, it's different. As you know, it's been an area of criticism, how you really define them. But as of the latest research, commodities, BTC and ETH, Bitcoin and Ethereum have been qualified as commodities since they're decentralized enough to not qualify as securities. Essentially, there's also securities in the crypto space. So STOs, which have been the hype for a while. There's centralized tokens. So if a token is not validated from the efforts of a decentralized community, as in the case of Bitcoin and Ethereum, it's considered a security, at least in the regulatory framework currently available. And there's cash equivalents, of course, Tether and DAI being examples of them. Then there's sources of income. In terms of sources of income, there's trading in traditional finance, dividends, and yields. We, of course, in the crypto space have different frameworks for sources of income. Aside from trading, there's mining, if it's a proof of work cryptocurrency such as Bitcoin, and there's staking in the case of a lot of the smart contract platforms and Ethereum 2.0 and many more. Volatility, as many of you may know, cryptocurrency space is a high or very high volatility and risk associated with investing in this space, whereas traditional finance is known for being low or medium volatility, at least by and large. And in terms of market maturity, well, the frameworks used to analyze and just the whole stocks and the traditional finance space is a very mature. It's efficient to a degree. Depends of if you believe on efficient market hypotheses from Eugene Fama, but it's certainly more efficient, I think we can all agree, than crypto finance, which is a nascent space. It's been around for a decade at most, traded for a little less since exchanges weren't available all the time. And in regards to sources of alpha, well, there's behavioral, there's some that apply to both crypto space and traditional finance. and some that are native to crypto space, which is something we're looking at closely at Into the Block. So there's behavioral, which is in regards to how a group of people or the whole market is treating an asset, So this is in the case of bubbles or panic that leads to market inefficiencies. There's analytical sources of alpha, which is in regards to which tools analysts are using to use to exploit inefficiencies in markets. There's informational, which is in regards to information asymmetry. So if an investor has information that's not publicly available in the sense of traditional markets, they can use it to benefit and better price assets. There's technical, which may have to do with regulations or some other more specific cases. It's traditionally not as in technical analysis, but technicalities instead. And for blockchain specific, which is of course our main area of focus, well, there's a completely different financial architecture, despite the regulatory lack of clarity. There is a whole completely different set of incentives for the actors involved. So that brings completely new business models and ways to price assets, which can lead to different sources of alpha. And of course, there's the blockchain network that enables protocol-specific sources of alpha. So the blockchain, all blockchains, well, permissionless blockchains being public and immutable, they provide new forms to analyze assets by combining your personal information with information from the blockchain, other positions. And this is a great opportunity for us to leverage something that was previously unavailable for the average investor. So now I'll talk about the approach that we've been using at Into the Block to tackle this massive I wouldn't say issue, but this area. So this is a bit more regarding our strategy at Into the Block. We're of course known for our analytics products. So we started with infrastructure intelligence, as we believe a digitally native asset like cryptocurrencies, crypto assets, deserves to have a completely new infrastructure of intelligence to it. And then we've moved towards the anonymized intelligence. So some of you might have been in my previous webinar regarding exchange analytics. And that's an area of focus of ours, as well as analyze behavior from decentralized exchanges, miners, and over-the-counter trading desks. In terms of what you can see on chain for those. And finally, which is the area of focus, we have behavioral intelligence. And it's a new area, and there's definitely a lot of potential for innovation. In terms of delivering actionable intelligence services, the way we approach it is that there's our core market intelligence, then there's two main types of actors in cryptocurrency trading, at least, and portfolios. Those are exchanges, if you essentially trust them to have your tokens and hold your private keys. And there's also specific investors or holders, which could be either yourself or through a third-party wallet service. And finally, depending on the actor you use and your patterns in general, you might be more interested in alpha-generating strategies to be supplied by Into the Block, or intelligence service in other areas that I'll get into right now. And essentially, the whole approach that we've taken is combine, essentially, embody the work that we have been doing with our signals, with our predictions, which is one of our forthcoming releases, and combine it with our existing financial indicators, network activity, ownership patterns, such as concentration from large holders and whales, exchange heuristics, which, as I mentioned, something we've been working on recently, sentiment, derivatives trading, and combine it with the user's portfolio and trading history in order to provide and supply portfolio intelligence signals native to the crypto space. So the approach we've taken is supposed to help you regardless of if crypto is 0 to 1% of your portfolio, or if it's 100% of your portfolio. So it's essentially based just to improve your portfolio, regardless of the approach that you're taking with crypto as part of your overall portfolio. And with that in hand, we've developed some insights. So as I was alluding to previously, we've been working on portfolio asset price predictions. There's the work we've been doing is regarding real-time predictions. This has been the product of months and months of analyzing multiple machine learning frameworks, from convolutional neural networks to bidirectional long short-term memory networks. And we've finally accomplished to have a highly accurate accuracy on predictions. And this will be shipped, of course, first in our platform. Then we will be looking at implementing it in the portfolio analytics tool. But the key is we will be democratizing the access to algorithms that was previously inaccessible for the average person, the average investor. There will be tailored to your holdings. So ideally, we'll be covering several crypto assets, starting, of course, with Bitcoin and Ethereum, the main ones. And well, it's just to be clear that it's not to be used as financial advice, but it does enable you to look at your portfolio in a way that's previously unavailable in traditional finance. Another area that we've been working on in our platform and we will be shipping in our portfolio analytics is Onchain support and resistance. So based on our in and out of the money around price indicator, we've been able to determine key clusters of support and resistance. So buying and selling areas based on the positions on chain. Of course, this chart is a bit outdated, as you can imagine from the prices. But the key is, and what we've seen from testing this continuously, is that there's resistance from holders looking to break even at prices that they previously have bought before. So 10,000 is a key price area, of course, that a lot of holders have bought in previously, either in 2017 or in the rally of summer 2019. And we're currently seeing some resistance there, in part because there's a lot of the people trying to break even at the levels that they have previously bought. And there's also support from holders, on the other hand, looking to add to their positions and accumulate more. And that's two of our areas that we'll be looking into. But another area that's completely native to the nature of crypto assets is that you will be able to personalize these and compare yourself to how you look in the broader picture in terms of addresses in the blockchain. So one of the most exciting ones that we've derived from that mentality is the personalized version of the in and out of the money. So you will be able to track how your position compares real time and your profits, of course, versus the rest of the blockchain, which is something completely novel to the nature of crypto assets and that you wouldn't be able to do in traditional finance. Of course, with options, there's a concept of in and out of the money, which we've borrowed for the terminology. But being able to compare yourself versus the rest of holders of a particular asset real time and historically track your profits in comparison to the whole picture is something that we're really excited for, and we hope you as a user enjoy. And of course, if you add to your position or reduce your position or buy at a different price level, it will be continuously updated so that it's still accurate. In the same line, we will be launching concentration personalized indicators, So similar to the indicators we have currently in our platform of whales, investors, and retail, we track in the major blockchains the holdings, the amount of holdings per token in each in each range essentially, and from that information we can essentially qualify or rank where you rank along the lines of concentration. Of course, I expect most of us are not exchanges or extremely large holders. So, but it's great to have the large picture, and we can do it in comparison to all addresses or similar addresses. So with our de-anonymization of information in the blockchain, as I mentioned before, we're aspiring to essentially not exclude exchanges and large holders, institutional holders, from the comparison to individual addresses in order to have a more accurate comparison of where you stand. And it will be, of course, updated real time, and you'll be able to track your concentration rankings through time historically and updated according to changes made to your portfolio. Finally, the other last personalized token indicator that we've come up with and have been testing for the past few months is your frequency. So in terms of trading activity. So it's an extension of what we have with our ownership by time held indicator, which looks at three different groups of holders. So we categorize as hodlers those who have been holding for more than 1 year, traders, those who have holding an asset for less than 30 days, and cruisers, those who have been trading for between 1 month and 12 months. So you will be able to categorize yourself as one of these, but not only that, but also more importantly, compare yourself how active you are versus the other addresses. So right now you can see this information is based on the Bitcoin blockchain. Of course, it's just a demo of what we will be shipping at the end. But most addresses are actually hodlers or been holding for more than 1 year. So if you have an average frequency of trading in this range, you would be ranked amongst the top 10% most active addresses. And you'll be able, as well as with the other indicators, compare yourself versus other addresses in the network or those similar to you, excluding large parties, and track it real time, historically, and update based on your patterns, of course. And well, other portfolio signals that we have been looking at, and they may or may not end up in the final product, is our crypto adjusted ratios. So at the beginning of the presentation, I mentioned a little about Sharpe ratio and how it's calculated. Well, there's earnings, of course, and you subtract your return versus the risk-free return. But there's some iterations that you can do it so that it's native to crypto, and this is actually something you can do right now in your own portfolio. It's not too much work. Essentially, if you're mining or staking a cryptocurrency, you can add that part to the return, and if you can also calculate it versus a benchmark. So if you don't feel like you don't want to compare it to the risk-free return, if you're more if you want a more aggressive on risk tolerance, you can calculate it versus a return of Bitcoin and the standard deviation of volatility of Bitcoin. So you can compare your risk return more accurately for crypto assets and adapt it from traditional finance. Another product, feature, I guess, that we were working on is addresses like mine. So based on the whole personalized activity and indicators that I've shown, we will be able to cluster essentially many addresses that are behaving similarly or have similar holdings, similar percentage return, in order to provide context essentially of how the market is positioning. And it can be helpful for you, of course. You do not have to act the same way as other addresses, but it does provide insights on how the market is positioning, and you can adjust your portfolio accordingly. Trading patterns analysis. So this is more in our machine learning side. We're looking at analyzing some of the key patterns. So let's take it into consideration, for example, a trader that bought at 19,000 in December 2017, and again at 13,000 last summer. Well, our trading pattern analysis might tell the trader, the user, that the market is currently, that you've previously bought at points where the market is heating up or it's been overextended, and take those insights and feed them to you in order to improve your trading or your portfolio based on your needs. And we're aiming to also, based on what we have in our derivatives chapter and into a blog, have a simplifier, which essentially, based on if the market is risk on or risk off, will provide options to hedge your positions, and also double down if you're more risk tolerant. In terms of implementation, well, as many of you may know, it's a key part at Into the Block, as in with any company. We're having several approaches to look at this, about how to ship this product. One is to work with, of course, top crypto exchanges and wallets, as well as having an Into the Block account integration paired with your Into the Block account in our website. And I chose specifically the most generic stock photo for implementation, because at the end of the day, it's something that affects all companies, and it's something that, with so many efforts that we're doing in research and implementation, it is a matter about implementation and fitting everything correctly. And well, at the end of the day, it's work in progress. We have several features that we're going to be hoping to launch before portfolio analytics, but we just wanted to be transparent about the work that we're doing, and so that we can get feedback and also provide a better service for you. In terms of conclusions, finally, traditional portfolio analytics, the reality is they may be outdated. As I said, there's tools, analytics from the 1950s or 60s that are still being used as the main one. There's key differences between crypto assets and traditional finance that essentially allow for us to analyze the crypto assets in a different way. And given the nature of a public and immutable ledger, such as the Bitcoin blockchain or other blockchains, we are able to provide personalized solutions, such as the one I discussed, that will be able to compare yourself versus the rest of people, the rest of addresses in the blockchain. And finally, as I stated, it's work in progress. We appreciate you tuning in, and make sure to send us some feedback. I'll provide my email at the end of the discussion. I'll be looking into those, and we really appreciate that. So follow us. And keep an eye out for our releases. Our next webinar will be on predictions, unsurprisingly perhaps. Jesus will be taking this one, our CEO, and it will be regarding our release that I've been teasing for. Yep, and our team just posted the link. Feel free to register. We've been teasing predictions for a while, and we're excited to finally launch them by the end of the quarter. Thanks for tuning in. Let me know if you have any questions. And as I said before, this is my email. Feel free to contact me if you have some feedback regarding what you're excited about in portfolio analytics, or some general feedback about a product in general. So Alberto is asking when our product is going to be released. Predictions, we're aiming to be launching before the end of the quarter, whereas portfolio analytics, well, predictions is a prerequisite for that. So we will be also implementing other techniques, and it will be we're aiming to ship it in Q3. Thanks for the comments. Glad you guys enjoyed. Another question from Alan. How do you combine old tools with new tools in data analysis? So it's a great question, and I kind of hinted of ways to adapting them when I talked about crypto adjusted ratios. And the way we're looking at it is that there's essentially two approaches two approaches to that. For one, there is the adapting it in a simple way, just changing the denominators to those from crypto. So if you have, or nominators as well, if you have different returns from staking, something like that, you can introduce those variables into the equations. And it's actually not a very cumbersome process. And the second approach, which is the one that it's a bit more elaborate and we're focused on adding to the block, is essentially combining that whole universe of data that the blockchain is with those traditional techniques in order to provide you with novel indicators to analyze your portfolio. And another question is how you discard different metrics. So I guess at the end of the day, something we've been pushing in as our mission as an analytics company is to consider multiple indicators. We believe that just believing in one metric as a key for your portfolio to be successful is an invalid argument, and more information will improve your portfolio performance. So you can analyze, be it from our on-chain analysis or more traditional, and essentially trial and error, constantly iterating to find which ones do not work, and then you can discard those. Do we have, Fernando's asking if we have beta testing program. So that is a great question. Our team should be available. I believe we had a beta testing before we launched the official version. Unfortunately, I'm not 100% sure if we have one at the moment. I will make sure though to look into that. And our team, if you have a response, feel free to contact them directly. Another question, well, statement, I guess. I would love to see this solution integrated in a mobile multi-coin wallet app, for example, like crypto.com, where you could pick your risk profile and have it automatically trade for you. Is that interest or possible in the future? Looking forward to the next webinar. Thanks, Mark. And yes, it's definitely something that will be possible in the future. First off, there's already traditional companies, robo-advisors, doing this in traditional space based on your risk profile, recommend certain type of assets and asset allocations. In crypto, however, there's the main difficulty of this being accomplished is that diversification is very iffy at best, since there's a high correlation, asset correlation between most tokens. So at the moment, we believe it's still too early for that type of automatic trade and essentially portfolio adjustments. But we do see it as a huge opportunity in a digitally native asset class such as this. All right, I see some other comments of people interested to work with us. I really appreciate the comments and feedback. Thanks for everyone for tuning in. That's it for today. Make sure to join us in our next webinar 3 weeks from now. Hope everyone's fine and enjoy the rest of your day.